All right, this is Noel Christopher with Renter's Warehouse, and this is what I call the SFR talk with Noel Christopher. I have a great guest today, but the purpose of this this LinkedIn Live show is to talk about the real estate market, talk about what's happening with some of the economic data that comes out, talk about single-family rentals, and to bring on great guests to talk about those things, and also about real estate branding and what you can do to get your message out there. And there's a lot of data that we see on a weekly, monthly basis that can be interpreted a lot of different ways. So today I have a great guest, Darren Blomquist from auction.com. I actually quoted him in my last Forbes article of talking about where the mid-sized investors are investing, and it was a quote. Forbes actually corrected the quote and put it from where he used to be working, which was Adam Data. So that sparked the conversation with Darren, asked me if I could change it, which I have not been able to yet. But Darren's a great guest. He spends a lot of time analyzing housing data. And so I'm going to bring Darren in now. Darren, are you there?
I'm here. Good to be here.
Yeah, thanks, great to have you on. I appreciate having you on, and I apologize for I guess I apologize to auction.com for you being quoted in Adam Data, and Forbes was weird about that. Is they wanted, you said that quote at Adam, and so then they wanted to attribute it to Adam Data. But anyway,
yeah, which is understandable. Actually, I was alerted to it by the folks, my good friends over at Adam. Still talk to them quite a bit. And they said, by the way, did you notice that you were quoted in this article? And I said, oh, yeah. Yeah, it was a quote from my time at Adam. So it makes sense that they would cite it that way.
Yeah. So that's a great segue. Give me a little bit about what you do and where you came from. And just, I'd love to hear a little bit about your history.
Sure. I'm now at auction.com. I'm the vice president of market economics. So it's really a great job, kind of a dream job for me. That coming over from Adam, I was doing a lot of the same things, but I'm looking at market trends and also mining our own data, because we have this huge marketplace of data here at auction.com. We're selling 50 to 60,000 properties a year through our platform. We're not the sellers, but we are connecting buyers and sellers through our platform. And so that's a rich data set for me to look at, not just in terms of kind of the dry transactional data, but some of the behavioral data behind that, how buyers are interacting with listings on our site and how sellers are interacting. We've provided sellers with tools to change their reserve basically on the fly as they see buyer behavior and that sort of thing. So that's using that data along with a lot of the public record data and other data I looked at previously to figure out what's going on in the marketplace and communicate that to our buyers and sellers as well as internally to business. So that's what I'm doing here at Auction. And I came over, I do still see, it's not actually, I've been here about 9 months now, and it's not uncommon to see myself still associated with Adam once in a while. I was there at Adam, which was previously Realty Track, maybe a name that's familiar to a lot of folks. And I was there for about 17 years, which is crazy.
That is crazy. Wow.
From 2001 through really the beginning of this year, and got to see when I started there, it was Realty Track and really focused on the foreclosure market. It was really the first site to put foreclosure properties, foreclosure data online, as opposed to having to go down to the courthouse to find that or get it through some local provider who would mail it to you. So we were putting it online nationally, and that got a lot of interest. And then it also dovetailed with a few years down the road after I started, we began putting out a report on, we said, we have all this data on foreclosures. Let's put out a report on foreclosures. We don't see anybody else doing that. And we did that starting in 2005. And a couple of years later, things really blew up, and we were already the go-to source for foreclosure data, but foreclosure data became very important to a lot of folks, at the, a lot of folks in government, a lot of folks at banks and stuff were eager to be looking at that data. So that consumed my time for a few years, really just managing all of that and doing. It was an interesting combination. My background was in college was in communications and journalism, and that's kind of what I came out of. This really was a hybrid of what I was doing at Adam and Realty Track was a hybrid of that communication piece, but it really was data-driven communications and PR out to the world, and it became very important that we got the data correct. There was a lot of criticism early on. Some of it unfair, some of it maybe more fair, that of how we were looking at the data. There was a lot of folks that with a vested interest in not having the market tank. And when we started coming out with some of our numbers showing these huge increases in foreclosures, we got a lot of pushback from those vested interests. And some of the, we made corrections. There were some fair criticisms, but others I think were just more about the fact that, hey, we don't want this market to tank. So there's going to be a soft landing. Come on, this is just a soft landing. But anyway, that became very important for us to be very rigorous with the data and make sure that we were presenting it objectively and fairly out to the marketplace.
So that leads to a couple of questions. One question is, do you consider yourself an economist?
It's funny. I'm actually going back to school and taking for my master's in economics. I'm on that path right now,
right.
And so it's amazing. I mean, I was just at class last night actually, so that's fun. So I guess I'm avoiding the answer, but no, I don't consider myself an economist, but I consider myself a data storyteller is the way I'd phrase it. And there's a lot of principles of economics that I have to understand to,
of course,
learned over the years. But I'm bulking up some of that understanding with going back to school. But really the storytelling piece of it is, and I guess the narrative towards storytelling piece of it is where I have my strongest foundation.
Yeah.
Yeah.
What's interesting is sometimes because I make a lot of commentary on the housing data myself, and you have to understand even just understanding some basic economic principles will put you ahead of a lot of people who in the media interpret data. I'm curious on your view on this, because I've had some people push back on me and say, well, I'm not an economist. Why should they listen to what I say? And I kind of look at it a little bit differently, that, you don't have to be an economist to be able to tell the story about data and to be able to interpret some data. Economists, a lot of times, are looking back, and they're not necessarily, and I'm curious on this because I am not in economics. I took some economics in college, but whatever. Economist isn't about predicting the future, right? You're not, as an economist, you're not there to go, this is what's going to happen in the future. It seems to me that an economist is more about saying, here's some things that we should do to avoid something bad happening. Here's how I interpret the past, and here's how I see things now. And then you can kind of make some assumptions or some predictions of what's going to happen in the future. But it's not about going and saying, this is what's going to happen for the next year. And that's why it's hard when you look at some data and they go, well, home price appreciation is going to increase this much the next year. It's like, well, okay, how do we really know that? What principles are those based off of? The other thing is,
just to Yeah, I think that economist, it has become a synonymous somehow with a with a predictor of the future, and that's not necessarily the strength of an economist. There's some elements of that, and there are predictive analytics and regression analysis that you can do to do some prediction based on data. But I think the core of an economist is being able to explain what's going on now and how to adjust. Basically, at the end of the day, it's a cost benefit analysis of what's going on now and making adjustments to make the best for individuals and corporations to make the best optimal decisions about
right.
Doing that cost benefit analysis to make the optimal decisions to make the most profit and at the lowest cost possible, make the most revenue at the lowest cost possible. So it's more about making those decisions now as opposed to necessarily predicting the future, although there is an element of that.
Right.
But yeah, I think, and economists are, often not right about predicting the future. So I don't know that that's necessarily a qualification for whether what you're saying is valid or not.
Well, I think that kind of leads into the next thing. And I don't know if, and we talked about this a little bit before the show. I recently read Robert Schiller's book on narrative economics. And what made that so interesting to me is that, for one, economists are many times incorrect in predicting the future, not because they're analyzing the data incorrectly. It's that because narratives sometimes can change the economics going forward, where you just can't predict it. So talking about the last recession and what truly caused that and what could cause, things going forward, is that sometimes viral narratives or narratives that become viral can then change a whole economy and move a market. And so that's stuff that there's no regression or numbers or data or anything that could figure that out, because the sentiment of people and, it's the same thing when back in October, November, December last year, everything started coming out that there was a housing crash, and that, people, it starts becoming viral in the news. And there's still a lot of people pushing that now, that we're headed into a housing crash based on faulty economics, really, truly, when they interpreting a number now. And there's going to be a certain percentage of them at some point will be right, because I look at people, and they've been saying for 4 years that we're going into a housing crash, and they keep every few months, and there's any kind of little data that looks a little bit off, they say, well, we're going into a housing crash. So I'd like to get your kind of opinion on where the housing market is now. Most people who watch me at all kind of know my opinion. And we have a couple of questions that have come in. Do you know Camille Renshaw? Somebody asked me if somebody
it's not ringing a bell right off the bat.
Used to work with. Yeah. So anyways, kind of where you see it now, and my focus is a lot in the investment world, but I talk about the whole housing market in general, because I get calls from investors all the time that says, what should I do right now? Is there going to be a crash? And usually my answer is, does the deal make sense today? If it does, then it's going to make sense.
Yeah.
Especially in single family, where you have less volatile rents and the values are less concerning, really.
Right.
When you're looking forward, because of the
there's a lot there to unpack.
Yeah.
But starting with, I love your comment about psychology and our narrative, and I need to pick up that book by Robert Schiller and read that. Sounds fascinating. But I think, to me, that the last housing downturn was so extreme, and combined with the Great Recession, that is driving the narrative now. It continues to drive the narrative. In some ways, I think people are. I think of it similar to the Great Depression. When I talk to my grandpa, or I used to talk to him when he was still alive about that going through the Great Depression, that had a huge psychological impact on how he handled money. And I think the same is true, that the housing downturn was so extreme, and the Great Recession it has had a huge psychological impact on how we view home ownership, on how people view home ownership. To me, they're much more conservative about getting into debt for a home, and that's why you see ownership rates lower. But it's colored the narrative in many other ways too. To me, it's coloring the narrative of those folks who are saying, yes, there's another housing downturn around the corner, and keep looking for that dark cloud, is because they saw the last one and they don't want to get caught off by another one, the next one. And so that's, I think, partially coloring that narrative. But to me, the overriding theme is that because of that, it's just hyper awareness of how bad the last downturn was. There's a lot of energy going into avoiding that happening again. And so it's less. Now, I think there are signs. I try to look at the data and be honest with it. There are signs that there could be a recession in the next 12 to 18 months and that sort of thing. But to me, it's very unlikely that we would see a repeat of what we saw in 2008. And timing the market is tough, and of course that's an overstatement of the session. And so I mean, I looked at I actually just did an analysis of the last 3 recession and delinquency data. You do see a uptick in delinquencies every recession, but the magnitude of the uptick in the 2008 recession was just crazy. It was like a 671% increase in delinquencies.
Yeah.
Whereas the previous 2 recessions, if you average those out, it was more like sorry if I get this number wrong, it was maybe a 20 to 40%. I know that's a big range, increase in delinquency rate.
Well, but when you're talking about a delinquency rate of, like, what's the delinquency rate today?
Well, it's right about at 1%.
Right. So if a 40% increase in that is, I mean, we're talking about kind of small numbers here.
Yeah.
And that's important for people to understand. And I also think, there's that false assumption that because that every economic recession comes with a housing downturn, right? Mm-hmm. And that seems, and I'm curious on your opinion on that. From what I've seen, it doesn't necessarily mean a wholesale housing downturn. It's very regional and submarket specific and asset class and all that.
Yeah, and so I think, in that same analysis, I looked at home prices over the last 3 recessions, and others have done more extensive research going back even further than just the last 3 recessions. But the last 3 recessions, you have this 2008 that's coloring our narrative today. I think, as I said, there was a 36% decrease in median home prices, at least using the data I looked at. There's variations, but it was, that 30 to 50% decrease in home prices in many markets, which is just crazy. If you take that out and just look at the other 2 recessions, one of the recessions, the 2001 recession, had it was a 1% downturn in home prices, and this is nationwide. So basically flat. The 1990 recession had a little bit bigger. I believe it actually was a double-digit 12% decrease. If you average those out, it's like a 6% decrease. But if you go back to further recessions, you see there's not always this consistent big decrease in home prices in a recession and downturn. And I think for your audience, it really does, even if there is a slight downturn in home prices, or even a fairly significant downturn in home prices, that's not going to matter, I don't think, as much to the single family rental investor as it is to the fix and flipper. I mean, we can get into this too, but I've been surveying the buyers who use auction.com. Traditionally, those have been more heavily tilted toward fix and flip type of investors. those investors are much more sensitive to variations, even short-term downs in the housing market, like we saw in 2018. We saw the sales rate of properties on our site plunged. Maybe plunged is too high of a word, harsh word, but it went.
You said it. It's Emma's going to pick this up.
I don't want to sensationalize, but it went. We saw that pull back as those buyers became a little bit scared that the market was turning down, but it's picked back up, and we saw that pick back up early this year, even before we saw some of the positive signs in the housing market. So I do think investors are on the front lines of the market, and they usually see what's coming before a lot of the rest of the market does.
Absolutely. Yeah.
And so we saw that pick back up. Anyway, all that to say, those type of investors are more sensitive to even like short-term slowdowns in the market, whereas the buy and hold investors are less concerned with that.
Yeah, and that's something that look, I don't believe that we're going into a big housing downturn. Obviously, things can fluctuate market by market and depending on the economy and some different things. But I can tell you this for sure. I work with a lot of large institutional, mid-sized type investors, and in my business and what I do, a 5% decrease in value of homes around the country would be a boon for my business. So like, that's what I try to explain to people. I don't have a narrative that I'm trying to push. It's just how I see it. A downturn would actually mean more business for what I do, because it would enable investors to buy in some of these markets that they've been priced out of because the yields are too low. That being said, and I would interested to get your opinion on this. It was some of the last stuff in that Forbes article talking about, I mean, I have guys where they're looking at some of these top markets and they're just saying it's not worth it for them to get a 5.25% net yield. And so they're going to these outlying areas, the kind of the hipsterbia thing, which is the great live, work, play environments. There's a lot of larger metropolitan areas that are in trouble with debt and pensions and all this kind of stuff, or whole states that are having those issues. Whereas you go to some of these other outlying areas where they've opened themselves up for business. They're maybe in between two major markets. Especially in the Southeast, there's a lot of markets like this to where there's a lot of people moving there. They've opened themselves up for jobs, for business, and they're more affordable. And so you have people that are flocking there. And regardless of all of that, you still have a lack of savings with a lot of millennials, a lot of people that are buying. They have some issues maybe buying a house, or they choose not to buy. And that's something we're seeing with some of our people, our tenants and owners. We have some people that we manage homes for that are renters, that they rent the home they live in and they go and invest in other homes in lesser expensive markets. And that whole world of investing. And the reason I want to ask you this is because you see this at auction.com, where it is now the borders are starting to be removed much more for investors to go and invest into markets that they don't live in, that are outside their geographic region. And we're seeing where it's starting to shift to where it was the majority of people would own a house, own an investment property, within 20 miles of where they live. Now it's shifting to where they can buy and own in multiple markets and have, whether it's a company like ours or a different company that allows them that to invest. And then there's also more liquidity in the marketplace, where it's easier to sell an investment property, for example, because of companies like ourselves and Roofstock and auction.com and things like that, where now there's just more liquidity in real estate in that sense, along with all the disruption that's happening in the overall real estate market. So that's all really interesting to me, because people talk to me a lot about these markets that are overpriced in their opinion. And my answer is just like, well, go to the next market over, because now you can invest there. There's always been investors buying investment properties in these markets. There's just more of a spotlight on them. I know that was a lot there, but
yeah. And it's interesting. So a couple of things that stand out about what you said and in the data we look at from our buyers is that, first of all, when we surveyed our buyers recently, the Southeast was the number one spot where they are investing. 73% of buyers are investing in the Southeast. And then the Midwest was second. And so those markets, which is interesting because, again, I said we have that more tilt toward the fix and flip rehab buyers. But another interesting thing in the survey was that we are seeing, there are actually 36% of our buyers saying that they are employing the buy and hold strategy.
Has that number shifted over the year, recently, or is it
data? So I don't know, but when I talk, anecdotally to the folks who've been here longer, they say that they believe that has been shifting. And just I talked to some of the individual buyers who've said, there was one in South Florida that stands out, and he said, yeah, I bought, and by the way, most of our buyers, we do have some institutional buyers, but the majority are mom and pops and, buying 1 to 5 properties a year.
Well, that goes, I want to make one comment on that real quick because someone made a comment, Michael Polk, who I know from the Forbes Real Estate Council, and he's talking about how, institutional investors only own 2% or so of all SFR homes, and then 87% are owned by investors who own less than 10 units. And that's not changing. I think what I'm seeing is that these investors are now able to, I see more people come into the single family rental investing space. And, you don't have to go to a investing club anymore and have them find some provider in a market where you're paying this big upside to. You can actually do it yourself. It's much easier. Or you can find somebody who can rehab for you or provide you a rent ready home. But so continue on there. But that's interesting.
That's the trend we're seeing in our user base, as well as I saw it in the public record data back at Adam, and I'm seeing it here in our own data here at Auction. But that mom and pop, what I call mom and pop investor, I don't know if that's the best phrase for them. Anyway, this guy in South Florida was saying he bought a couple properties on auction.com last year. He was planning to flip both, but because of the market conditions there, he switched. He did flip one, but the other one he held on to as a rental. And so we are seeing, I believe that realization, especially if home price appreciation is slowing down, that fix and flip strategy may not work as well.
Yep.
And so the other thing I could comment on about that is it's actually good for our sellers too. The rental strategy, when our buyers are employing that rental strategy, often they have more wiggle room to go higher on what they're bidding on the properties.
Yep.
And still have it make sense for them. And maybe the buyers don't want to hear that, but I actually had another buyer in the Philadelphia area was saying, hey, if I was fixing and flipping this property, I would bid X amount on it, but I would go higher if I were holding it as a rental. And so that's been, and we see it in the data too, analyzing properties that are held after they are purchased off of our site. If they're held for at least a year, that subset of properties had a higher winning bid to reserve ratio. The reserve is the amount the bank is looking to recover than properties that were fixed and flipped. So interesting trend. I think that's good for our sellers, as well as this moving toward the rental strategy.
Well, I mean, and we deal with this all the time. And whether it's dealing with a fund that owns thousands of homes or somebody, I mean, the majority of our people that we manage our 22,000 homes for own 1 or 2 houses. And we work with some larger funds. I work with more larger funds, but it's really yield driven. And so, cost of capital is still low. And it's great because that's enabling somebody to be able to buy more house for their money. And that goes whether it's an investment property or a house they're going to live in. But when you really look at the buy and hold strategy compared to fix and flip, you are, after you get 5 years, you get through that first 5 years with just average appreciation, average rent appreciation, your ROI gets exponentially much better as you go on. And so we have people that call us all the time that, because a lot of our original customers were accidental landlords. And the market's gone up so much since they became an accidental landlord that they're either at or above where their value of their house was when they couldn't sell it during the downturn. And they come to us and say, well, they want to sell. And I'm like, well, why? What's the point here? And many times, and we talk about that, what's coloring the narrative is that they're like, well, I made it out of the last recession. I don't want to get caught again. The house has gone up in value and I want to sell. And they don't even really understand the tax implications or that, they could just hold this long term and it's going to continue to go up in value, even at a just average rate. And that's something that we push a lot, is that you can't look back in the last 5 years or 8 years and say appreciation is going to hit that same number. You need to look back further and kind of look at that average and just see where you think things are going to go. So I want to get a little bit more about on auction.com, because I've had some conversations, as obviously there's a supply issue right now, and I have investors that are out there trying to find properties. And I've talked to a lot of realtors, a lot of guys in what we call providers in local markets that are going out there buying houses, rehabbing them, and selling them, not as turnkey, but as rent-ready houses. Usually they're partnering with a fund, a mid-sized fund, and they're in it from the beginning, as opposed to a turnkey is where you're buying a house after it's completed. A lot of these investors will buy with the provider. They'll buy the house, and then the provider will rehab it, and they pay for the construction. A lot of guys are saying that a lot of stuff, or a lot of the good properties for investors, aren't even hitting the MLS. A lot of them are, and this is anecdotal, by the way, a lot of them are going through the auction route first. And then, the MLS is kind of the last resort of some of the banks that, if they're selling a property or unfolding a portfolio or whatever they're doing. And so I would like to get your opinion on that, and maybe go a little bit deeper into what auction.com is and what it isn't, because I think some may, seasoned investors understand what you can get there, but some people are thinking that, maybe it's just it's a distressed property that is trying to be moved on auction. It's not like that anymore, right? I mean, are
Right.
you guys really acting more of a true marketplace and selling at a fair market value?
Yeah, that's really interesting, and I would say insightful on your part to recognize that. I mean, we've worked through the majority of properties that we're selling. They're still distressed in the sense that they are in foreclosure, but they're not distressed in the sense that these are aged inventory, which
Right.
is that tends to be in poor condition. Now, I mean, there's a balance there, but one thing I would point to is that for the last couple of years, the majority of our inventory is coming from post downturn loans, is one way to look at it. So loans that were made after 2009, and so you have newer vintage loans, which are newer, properties that have been owned for a shorter period of time. And one thing that's actually caught us somewhat off guard is the price. The average prices have been going up. Now, we still sell I was just looking at this data, the average sales winning bid of our properties is about 78 to 80% of the full market value of the home. So there's this discount. Now, part of the reason for that discount is there is still some deferred maintenance, and there's some unknowns. A lot of it is the unknowns about the condition of the property. But you do have that discount. But one thing that surprised us is the increasing average sales price. It's still much lower than the overall market, but it is going up more in line with the market than it was a few years ago, if that makes sense. So it is less of that super aged inventory, highly distressed marketplace. And it's a marketplace where we are selling, the majority of properties we're selling are foreclosure or bank owned. But one of the things, we've disrupted the distressed marketplace by helping the banks understand it's actually better for them if they sell sooner rather than later.
Oh yeah.
They sell at that foreclosure auction rather than they never actually own the property at that point. They're selling it, getting it off their books. If they hold on to it and there may be good reasons for them to do that, but all things being equal, holding on to that same property for another 200 days that it takes to get it in, go in and look at the property, do any repairs that need to be done, get it on the MLS, that is actually going to cost them more than it would to sell it up front. So we're selling more of them up front, further up in the funnel, rather than them sitting it for a few hundred days or much longer in some cases in REO or real estate owned by the lender, which is when you start to see some of your deterioration in the condition of the property.
That makes total sense to me. And I think the banks learned a lot of lessons from the last downturn, which will, if there is any kind of a housing downturn in the future, or as foreclosures tick up for whatever reason, that there's so much more sophistication, whether it's on the investors and buyers or it's the banks on liquidating properties. That brings me to a question too. You mentioned something about the reason that the discount is where it is because lack of information and not understanding enough about the property. So the investors have to hedge their bets. And we see this, in portfolios. So we run into this, and I've been talking about it for the last week constantly we have a lot of sellers that come to us with a portfolio of homes that are rented and they want to sell them. And I've been out there saying, hey, investors will pay fair market value. There's a caveat to all of that, is that fair market value is really what the buyer will pay, and that fair market value is many, many times based on information. So we have a lot of sellers who have these great portfolios and they say it's in great condition. Well, an institutional buyer interpretation of great condition and an investor who's been getting a great return on a property, their interpretation of a great condition are almost 100% always different. And so we run into this where we have somebody saying they're in great condition. So then the buyer underwrites the home based on me as a broker in between saying, hey, these are in great condition, you can buy this house here or whatever. And then they go to do the inspection and they're like, no, these are in average condition. And you said great. And so therefore we want a huge price reduction and the whole deal blows up. So we've stopped taking listings for occupied for tenanted homes without them going in and doing their own inspection, a real inspection, not just some random photos. And so that's what we see a lot. And I wonder, what do you guys do, or what can you do in those instances? Are you able to, what data can you provide that helps a buyer understand what they're buying? Or is it really just all in the buyer to figure it out?
No, we're big believers in providing as much data as possible, but there are limitations. So we do provide a lot of title information, as much as we can about we provide photos of the outside of the property in many cases, but to back up a second, there's two types of auctions primarily that we do. We do the foreclosure auctions, which are specifically the ones that are traditionally at the courthouse steps, and you're paying all cash. And with those properties, the bank has never taken possession of the home, and so a lot of times the owners are still in the property, may or may not be in the property, but in any case with those types of auctions, you're not going to have, it's very unlikely you're going to be able to see the inside of the property to do an inspection. And so that's where that hedging of bets,
of course,
information we have from data sources that we can on the property details page. But there is a limitation when it comes to that inspection.
And when you're buying a house like that, is the new owner responsible for evicting the owner if they have to? And are they having to go through a foreclosure? Like, explain that a little bit.
Sure. I mean, when you buy it at that foreclosure auction, the foreclosure has been completed at that point. So it's been foreclosed on, you own the property, you are responsible for if they're the owners in there for eviction of the home, or eviction of the previous owner. And not all, a lot of these the homeowner has left,
right?
So but yeah, so you're responsible for that, and that's so that's part of that discount that's built in.
Right, makes sense.
And I should say that discount is based on not, it's not based on just a standard AVM full market value of the property. It's based on what the bank has valued the property at, usually based on a BPO. So it's a little bit more of the as is value.
It's more about the current condition or current value, not just what it would be as an optimized property, correct?
Yeah. So you have that discount built in because of some of those factors, and that's also a reason why. So you're taking on that risk. There is if the property doesn't sell to an investor at that foreclosure auction, then it does go back to the bank, becomes real estate owned REO, and then we also the banks can put the properties on the MLS, but they also, many of them opted to auction them off on our site. And with those, there is a little more latitude. A lot of times there may be some ability to look at the inside of the property with those bank-owned auctions. And so it's a little bit different situation with those REO auctions. And those are also all online. You don't have to physically go to the location to bid on the property.
That's great. That's great. And how has that trend changed over the years as far as courthouse steps auctions compared to having you guys just handle the foreclosure auction in this case? And how has that changed as far as, REOs going to a local agent in a market? I mean, how are you seeing that? I mean, do you guys keep data on that? Do you know? I mean, I know it's your business, so it's a lot of business that you guys go after.
Yeah, we've actually, a few years back, we kind of upset the paradigm, which was the banks just viewed the foreclosure auction as a checkbox they had to get through.
Mm-hmm.
They're saying, oh, there's actually a marketplace there of people who are interested in buying. And honestly, because of some of the obstacles to buying, you have interested buyers there who realize that that's an opportunity to buy. And so we've really, what I would say is we've created a marketplace at that foreclosure auction, where before it was not really a marketplace, it was just a hoop that the banks had to jump through. So they weren't really selling very many properties there. They were actually taking most of them back. Now
Right.
You see it's actually over 40% of the properties that go to that auction, at least that we're handling. And we handle by far the most of anybody nationwide, but of the ones that we're handling, over 40% end up selling to an investor at that foreclosure auction. The other 60% then go back to the bank. And we are seeing more buy-in on, still the majority of them, of those 60% end up on the MLS, but we are seeing increasing buy-in that to auction them off online using our platform or another platform, because there's this realization that time with these types of properties, the longer you hold the property, the more risk there for the bank.
And that makes sense. All right, I want to switch gears a little bit, kind of at the end of this. And we're going to have another call to talk about see if we can do some business together as far as companies. And I think that could be really interesting. But what do you think about some of the things that, some of the new marketplaces, and then also iBuyers? What do you think about this? I have some opinions, and I think it's deeper than just looking at, as far as iBuyers go, there's something interesting that came out from Zillow talking about how they're not trying, it's not about the spread, it's about capturing the transaction. And I agree with that with a lot of the iBuyers. It's not all about that they buy a house at 90,000, they've got to sell it at 100 to make their money. And that's why some of them can operate in at a loss because they're really capturing people at the top of the funnel. And I'm seeing this with banks, with lenders, with iBuyers. It's all about capturing that customer, and it's fee based. And it's whether it's the fees on the transactions, whether it's the fees from the title companies, because for example, OfferPad now, I'm sorry, Opendoor now owns OS National, so they're getting into more of these consumer services. So, and then on a whole other side, there's a professor out of University of Boulder. I think it's Mike Del Prente or whatever. He analyzes a lot of this, and it's really interesting looking at the debt structure of these companies. So when a company says they raised 500 million or raised a bunch of money based on a $1 billion valuation, how much of it is debt? How much is equity? How are they leveraging themselves? All that's interesting. I don't know if you look into that, but I'm curious on what your opinion and what you think about the iBuyers, and if they're for real, if this current iteration is going to be the final iteration, because sometimes I think about that as well, as like, maybe it will end up like this, but I think that there's a lot of disruption and, in the real estate world, and then you get into the commissions and all this kind of stuff. A lot of things are happening, and coming soon listings and pre-listing, pocket listings, whatever, everything's being disrupted right now. And I hate that word disruption, but anyways,
it's the word du jour. But yeah, I started looking at iBuyers quite a bit back at Adam in the public record data, and I've continued to track them. Early on, I was like, I did think there's something real to this, because I could see the transactions happening in the data. A lot of other so-called disruptive companies that I would hear about, I'd be like, so how many transactions have you actually done?
Oh man, I have conversations all the time with a lot of new startups in the real estate space, and I get to that question, and it's it's like, well, we've done 50 transactions in California and Seattle. It's like, well, those aren't markets like the rest of the country. So, anyways, continue.
Yeah. So I looked at the data and I was like, oh, I'm seeing hundreds right off the bat, and it's turned into thousands, and so they were. Whether they were making money off of those transactions is another thing, but they were actually getting involved with the transaction, which to me is the core. Is if you can control the transaction in some way or be part of it, then that is what is potentially could be disruptive to the current model. And so now it's. I recently went and dug in and looked at the spreads between, just looking at what you were talking about, between their purchase price and their sale price. And when I looked at OfferPad, actually, I think was the highest. It was around like 16,000 spread on average of the transactions I looked at. Opendoor was more like 8,000, and this was, I think, it was in just Phoenix, if I remember right.
Yep.
And then Zillow was like 2,000. So they're
well, one comment on that. OfferPad, Opendoor has been around longer. OfferPad was, Zillow's a newer entrance into this.
Yep.
So I think that their margins are lower, and because they're in hyper growth mode. But that's just one way to look at it.
They're willing to sacrifice, and again, if it's not about that margin, that's not a big deal, I guess, to them.
Well, the margin's great, but it's the fees.
Yeah. Well, yeah, it better be the fees, because they're definitely not making it on that margin. And a lot of now, I think one point about the iBuyers in the investor world is it is disrupting to use that word, that the investors who are so-called flipping is there. To me, the Zillows and OfferPads and Opendoors of the world are making a similar value proposition.
Totally.
Buyer or to the seller. Hey, I'll take this property off your hands. I'll make it a lot easier for you. And traditional investors with that proposition has come a much more significant discount on the front end than what the iBuyers are getting. And so that's disrupting them. And when I talk to investors who are in markets where the iBuyers are heavily involved, they're having to figure out how to how to adjust their
Well,
strategy.
yeah, and so that goes back to my point about top of the funnel. If you can be the first one in and you can capture that seller, you're pushing out a lot of those investors. In my opinion, iBuying, quote unquote iBuying, has been around forever. I mean, they go in the local market, they find, many times, let's say somebody going through a divorce or there's a probate thing or whatever, and they're offering a price that they know they can offer and get it. I mean, look at We Buy Ugly Houses. I mean, Homevestors, they've been doing it for a really long time. They're very successful. So I always caution people when they're like, well, this iBuying model, it doesn't work. It's like, well, that's what investors do, but the difference is that the iBuyers can have a lower margin because they're not having to put all this money into the house and fix it up. And they're really looking at the fees. And those fees are going to get compressed over time as there's more competition. But it's all about the top of the funnel. It's about capturing that seller when they click search and they say they want to sell their house. And so their advertising is all going into that. And I've looked a lot into the iBuyers and the different ones. And, I know the guys at OfferPad really well. Know some of the people at Open Door, and I really like what Open Door is doing, and OfferPad. I mean, they've got some great things. Zillow, a little bit harder to see, but it's really interesting, and I don't think it's going away. And it's funny because I see these groups that'll come up and say, well, we start our iBuying program in Houston. It's a small investor. It's like, well, yeah, of course you can call it what you want, but it is what it is. So yeah, I think it's there to stay. I think that realtors, for example, that are working in this, the ones that are embracing this as part of their business model and guiding a seller through the process are going to be more successful. I think that people still want that human touch to a certain extent. And also there's that human intelligence side of it too. And that's why I think buyers are being more successful are the ones that have been partnering with the real estate brokerages, because you need some human intelligence from the beginning on areas, and it just helps. And we see that when we're buying investment properties. You can do a certain amount AVM from afar, but you need some of that human intelligence. So, it's all interesting stuff.
On the iBuyers, to link it in, is one of the last studies I did before leaving Adam was looking at iBuyers selling, and there is a linkage to the single family rental market where we found that 1 in 10 of the properties that they sold actually went to what we classify as an institutional single family rental buyer who was interested in taking that property as a rental. And then on the front, one of the things, so talking about how investors can figure out how to take advantage of the iBuyer phenomenon, is, I think, at least right now, this may not be a long-term thing, is the iBuyers are not taking heavily distressed homes that need a lot of rehab, at least as far as I know. And so the investor who can come in and is going to pick up those properties, rehab it, and then turn it around and sell it to the iBuyer, those investors can benefit in this market.
Well, and yeah, I agree 100%. And so a couple of things that I've learned recently on that note, the heavily distressed properties are not taking, and tenanted occupied properties, they're not taking. And what I mean by not taking is that, I heard some numbers back, this was probably about a year ago, and for Zillow, they were getting upwards of 30,000 requests in the state of Georgia, for example, a month, of people who wanted to sell their house and put a request. If it had a tenant in it, they were throwing it away. If it was distressed, they were throwing that lead away. Now, we've been working with some of the iBuyers a little bit. Can't really name them, but that taking those leads, taking those tenanted, those investors who are trying to sell, and what we call them tired landlords, and doing something with those, because there's a ton of investors who want to buy. And then there's, now companies popping up, for example, a company that we're starting to work with called Rentback, where they're buying a home from an owner, and then they're leasing it back to that owner and then selling that tenanted asset to investors. And there's all these different interesting models. Now, in my opinion, I think some of the companies are trying to make it too complicated by coming up with these niche ways where, or where they'll say a tenant can own, part of the upside of a property. And so they pay rent, but then they're getting the upside. And like, I don't think you need to get that complicated with it. It's pretty straightforward, but a lot of people are trying to figure out their different entrance in. And these are some of the companies that you ask them how many deals they've done, and it's been like 0 practically. So, but it's really cool to see all of this stuff happening in the market. And it just since I've been involved with Renters Warehouse the last few years, I mean, things have changed. The level of service has changed. It's becoming more institutionalized, and I've been involved with this for a long time, and you have too. Just seeing how everything evolves over time, it's been really great. So, yeah, pretty cool stuff.
Yeah, very yeah, and I feel like we could probably keep talking.
Yeah, we could talk. Well, I'm going to wrap it up. I appreciate you coming on, and we got some great, good snippets of information here. And I'm
glad that Forbes misquoted.
Right. Yeah, exactly. And we'll be talking later this week. Hopefully we can do some things together. I really appreciate it. And are you going to be at IMN in Phoenix?
Unfortunately, not this year. No, not in December.
Well, if somebody wants to follow you, what's the best way to interact with what you do? And I know you come on a lot of shows like this and things like that.
Yeah, absolutely. I think on auction.com, all the stuff, the research and content I'm posting is just auction.com/in the news. Just go there. Great place to track what we're doing, and also posting a lot of it on LinkedIn. So that's a great place to follow me as well.
Okay, great. And obviously to find me, LinkedIn is probably the best place to find me. I also have a YouTube channel that all of these shows go on to, but I'm putting out daily content on LinkedIn, trying to engage with as many people as possible. And that's really the kind of the new thing in sales. It's I don't even call it social selling. It is engaging, and you don't have to be in person to engage with people. So appreciate it, Darren, and look forward to continuing our conversation another time. Thanks a lot.
Yeah, professional.